Hello everyone. Today in this video we will be seeing class 11 accountancy. Class 11 accountancy, there are having two parts. The part 1 is financial accounting. So we are seeing today part 1 financial accounting chapter 2. Chapter 1 we have already completed introduction to accounting. Those who have not watched, I would request you to go back to the previous video and watch the chapter 1 of part 1 financial accounting. That is introduction to accounting. In this video, you will see the part 1 financial accounting chapter 2 theory base of accounting. Now we will just see the first part, that is the part 1 financial accounting chapter 2 theory base of accounting. Theory base of accounting. Also students, this video is only about a quick recall of chapter 2 theory base of accounting. That is the first part. Part 1 financial accounting. In that chapter 2 theory base of accounting. This is only a quick recall theory base of accounting. So students, now we will see chapter 2, theory base of accounting. Chapter 2, theory base of accounting. So before starting the topic, tell me one thing. What is theory base of accounting? What the name suggests? Theory means theory, that is not a practical. Okay, theory base of accounting. So what is accounting? Accounting is a practical. Accounting is a practical. So for to understand accounting, what is all about, we have seen the introduction to accounting. Now here a theory concept of accounting, that is you need to understand what is accounting, its theory, and those who are attempting the exams, the students can recall all the concepts, main concepts I have included here. You can recall the concepts quickly. So now we will start the topic. So what is accounting? Accounting basically means it is helping in providing information, right? Yes. So accounting means it aims at providing information about the financial performance or the financial status of a respective firm to its various users. Okay. We'll make it clear. Accounting. What is accounting? Accounting is nothing but it aims at providing information. It aims at providing information about the financial performance or a status of a firm to its various users. So accounting information, as I have said you, it helps in providing information. So which information? Accounting information. And that accounting information should be reliable and comparable. Like I said you in a previous video, it should be comparable with the terms, the methods, accounting terms, accounting methods and all. It should be comparable based on some consistent accounting policies, principles and practices. Okay, so this is called for developing a proper theory base of accounting. So today we will understand what's the significance of accounting theory. Why is the accounting theory so important? Okay, so the importance of accounting theory, actually there is no need to be overemphasized, as no discipline or rule can develop without a sound theoretical base. Please clear it. The importance or the significance of accounting theory need not be overemphasized, as there is no discipline or any specific rule can develop without a sound theoretical base. So the theory base, as the name suggests of the lesson, the theory base of accounting consists of its principles, concepts, rules, its guidelines. These all are developed over a time to bring uniformity and consistency to the process of accounting, and thus it will help to enhance or increase its utility to different users or to various users of accounting information. So apart from what I have said you, so apart from these, the ICAI means the Institute of Chartered Accountants of India. The ICAI, which is a regulator, you all may know. So this is a regulator who have given is standardization of accounting policies. You may be aware of the accounting standards as well as the IFRS. So this we will study here in chapter 2, theory accounting, theory base of accounting. So the ICAI, so what they have done, they are the regulator, so they have standardized the procedure of accounting by giving some norms or giving some rules. In this, they have issued some accounting standards. Accounting standards, we call it as AS. Accounting standards, we call it as AS, which are expected to be uniformly adhered to. Every firm should uniformly adhere to, abide to the rules what they have given in order to bring the proper consistency and comparison in the accounting practices. Okay, so what is this? In this chapter, we will be covering the accounting standards, the IFRS, the GAAP, that is the generally accepted accounting principles. We will come into it. The next slide is all about GAAP. The next slide is all about the GAAP, the main accounting terms and all. So slowly we are going to each and every slide, each and every topics will be done today itself in this video for the chapter 2. So students, see here. So what is in the slide given? It's gap. Like I said in a previous slide, we will come into each and every concepts. We will be covering each and every terms of this topic, of this chapter. So just we'll give a quick recall. What is gap? Gap means generally accepted accounting principles. So what is this? As the name suggests, it's generally accepted accounting principles, that is the rules or the regulations, guidelines adopted for recording and reporting business transactions in order to bring uniformity in the preparation and presentation of financial statements. So these principles are also referred to as the concepts and conventions. Concepts and conventions. So you just concentrate here what I am trying to make you understand. So what is gap? Gap means, like I said you, it's generally accepted accounting principle and it's a rules and regulations which are adopted to bring uniformity in preparation and presentation of financial statements. So from the practical view, we can say there are various terms such as principles, conventions, modifying principles, assumptions, basic accounting concepts and all and so on have been used interchangeably. Okay. However, the principles of what they are stating here, that is the principle of accounting, are not static in nature. Please make it clear. However, the principles of accounting are not static in nature. It can change. These are constantly influenced by the changes in legal environment, social environment, economic environment as well as the needs of the users. It depends upon these four, that is the legal environment depending upon the law, social, economic environment as well as the needs of the users. So what they have done is, in order to maintain the uniformity and the consistency in accounting records, certain rules, guidelines, regulations, principles have been developed which are generally accepted by all the accounting profession. That's why it's called generally accepted accounting principles. So these rules are called by different names such as principles, its concepts, conventions, its postulates, assumptions, modifying principles and so on. So the term principle, think AICPA, I think they have defined some principle for it. It's what principle is defined. I think so they have defined. It's a general law or rule which is adopted or professed as a guide to action, a settled ground or basis of conduct or practice. So the word generally means in general manner. Okay. So what is gap? Gap is nothing but, in short, you need to remember if in exam it comes, what is gap? So gap is nothing but generally accepted accounting principles. Generally they are accepted. So generally accepted accounting principles, gap. It refers to the rules, regulations, principles or anything you can take which are adopted for recording and reporting business transactions. Why they are doing? In order to bring uniformity in the preparation and presentation of the financial statements. In the preparation and presentation of the financial statements is known as gap, means generally accepted accounting principles. Now we will see the accounting main terms, that is the basic accounting concepts and the terms which everyone need to be clear enough. Not the exam point but also the day-to-day point of view, you need to be very clear about what are the concepts, what are the terms used in accounting. These are the basic concepts which are used in accounting. That is, you can see in the slide one by one. I will give you an explanation of all the concepts. So the first, that is the basic accounting concepts. What is that? It's referred to as a fundamental ideas or the basic assumptions which are underlying the theory as well as the practice of financial accounting and are having some rules, that is broad working rules for all these accounting activities, and thus they are developed by whom? They are developed by the accounting professionals. Okay, they have developed by the accounting professionals. So they have kept some rules and regulations, we should abide them. The important basic accounting concepts are as follows, which are you can see in the slide itself. The first is the business entity concept. Business entity. What is business entity means? Yes, this concept assumes that a business has a distinct and separate entity from its owners. From its who? Owners. Okay, make it clear. Business entity concept means the concept which assumes that a business has a distinct and separate entity from its owners. Thus, the purpose of accounting is to a business and its owners are to be treated as two different, that is two separate entities, not same, two separate entities. I will make you clear once again. Business entity concept means business entity. Business entity means this concept assumes that a business has a distinct and a different or a separate entity from its owners. Okay, so thus the purpose of accounting is a business and its owners are to be treated as two different or two separate entities. Okay, then next you can see is what is money measurement concept. So what is money measurement? The money measurement concept states that only those transactions, as the name suggests, money, in terms of money, it would be recorded in the books of accounts. Okay, now we will see here money measurement concept means what? The concept of, please listen carefully, don't distract. The concept of money measurement states that only those transactions, only those business transactions and the happenings in an organization which can be expressed in terms of money and only money are to be recorded in the books of accounts. Okay, only the transactions which are in terms of money will be recorded in the books of accounts. Also, the records of transactions are to be kept not in the physical units, but it should be in monetary units, that by default, because money measurement itself means to be kept in monetary units as well as in terms of whatever in terms of money is there, we need to record it in books of accounts. So if an exam, any concepts is there, you need to be clear enough what is there. As the name suggests, you should able to express the concept about it. So we will revise once again. Business entity. What is business entity? Means two different entities will be there. Okay. Business has different or separate entity from its owners. So there will be total treated as two different entities, that is two separate entities. Coming back to the next concept, that is money measurement concepts. So what is money measurement concept? All transactions, all business transactions, all the happenings in an organization, entire will be measured in terms of money and it would be recorded in the books of accounts. Also, after recording, it should not be kept in physical units, it should be kept in monetary units. Next comes the going concern concept. Going concern concept. Now, what is that? Going concern means for a long period of time. So this concept assumes that a business firm or any business firm would continue to carry out its operation indefinitely. Indefinitely means not for a short term. It will be for a fairly long period of time, and it would not be liquidated in the near future, you can say. It would not be liquidated in the near future. That itself means it would carry out its operations throughout the long period of time. So the concept of going concern, I will give you an example also. So the concept of going concern assumes that a business firm would continue to carry out its operations indefinitely. That is, it would continue for a fairly long period of time and it would not be liquidated you can say in the near future. So this is an important assumption of accounting, as it provides the very basis of showing the value of assets. Where will we show the value of assets? In balance sheet. In the balance sheet, we will be showing the value of assets. As an accountant, as an accounting student, you should be very clear enough where the head will go. That's where the value of assets will go in the balance sheet. An asset may be defined as asset, we can say as it's a number of services. Okay, when we purchase when we purchase an asset, for an example, you can say a computer, if we purchase for a sum of 50,000, let's say for a sum of 50,000 you have purchased a computer. Okay, So what we are going to do is, we are buying it really is a service of computer. Do we purchase it? No, we are only purchasing the service of computer that we shall be getting over its estimated lifespan. You can say, for an example, 3 years, 5 years. This is its lifespan. It will not be fair to charge the whole amount of 50,000 from the revenue of the year in which the asset is purchased. I'll give you another example. See here, instead that part of the asset. So what I've said, you have purchased a computer for a sum of 50,000, right? 50,000. So that 50,000 is your asset actually. But it's a service of the computer that shall be getting over the estimated lifespan. 3 years, let's say for 3 years, for 5 years, it should not be fair to charge the whole amount of 50,000 from the revenue of the year in which the asset is purchased. Instead, what we'll do is, that part of the asset which has been consumed or used during that term should be charged from the revenue of that period. This assumption is regarding with the continuity. You can say continuity. That's called as going concern concept. The next concept comes the accounting period concept. Now everyone will know what is the accounting term, that is the period. The accounting period refers to the span of the time at the end of which the financial statements of an enterprise or a firm are prepared to know whether it has earned its profit or it has maybe it has incurred loss during that period, and what exactly is the status of its assets and liabilities at the end of the period. That is termed as accounting period concept. So everyone may be knowing what is accounting period concept. The accounting period refers to the span of time. Please make clear, listen carefully. I am going little bit fast. The accounting period refers to the span of time at the end of which span of time they are referring, at the end of which they need to prepare and present the financial statements of an enterprise, which are prepared to know whether they have incurred a profit or they have earned a profit or they incurred a loss during that period, and what exactly is the status of its assets and liabilities at the end of that period is known as accounting period concept. Okay, the next concept comes the cost concept. Cost concept. The cost concept requires that all its assets are to be recorded in the books of accounts at their bought price. That is the what price they have purchased, that price. That is the cost price, which includes the cost of acquisition. That is the cost of acquisition, transportation, then installation if there is any installation, and making the asset ready for use. Okay. So cost concept. So what is cost concept? Cost concept means it requires that entire cost. How much is the entire cost? If you buy something thing which needs to be assembled and which need to be transported. So transportation cost, the acquisition, that is the purchase cost, transportation cost, installation, assembling cost, and all the costs need to be included. That is called the cost concept. For an example, like I will say you, an old plant was purchased. For example, you can say 50 lakhs. It was purchased by Shiva Enterprise, which is into the business of manufacturing detergent powder. Okay, which is into the company which is into the which sector? Manufacturing sector, manufacturing detergent powder. So he had purchased in the year, let's say June 2005, old plant. He has bought it for 50 lakhs by Shiva Enterprise. Okay, an amount of 10,000 was spent in transporting the plant to factory site. So then 50 lakhs plus its 10,000. Then in addition to it, 15,000 also he spent on repairs. That is the installation and all. Repairs for bringing the plant into running position, and 25,000 on its installation. So these are the expenses of the Shiva Enterprise. So what he will do, that the total cost concept will be 50 lakhs plus added to 10,000, 15,000, 25,000. Okay. So the total amount at which the plant will be recorded in the books of account, okay, would be the sum of all these which we have seen now, that is 50 lakhs 50,000. So for an example, again I will give you an example to clear, because the concept of cost is historical in nature, as it is something which has to be paid on the date of acquisition and does not change year after year. It will not change. Okay, and again I will make you clear with giving you a different example. If a building has been purchased by a company for 2.5 crores, building has been purchased by a company for 2.5 crores. So the price will remain the same for all the years to come, though its market value may differ or may change. Its market value may change. After 10 years, let's say after 2 years, 3 years, the market value will change. But the amount of cost at which the company has purchased will remain the same. That is the cost concept. Cost concept. So I've made you clear in the 5 concepts in the business entity concept, money measurement, going concern, cost concept, and accounting period concept. In the next slide, we will be seeing some new concepts altogether. Now we will see the next concepts. These are the basic accounting concepts. In this video, we will see now dual aspect concept. Dual aspect concept. So what is dual aspect? As the name suggests, dual means two aspects. So this concept states that every transaction has a two effects, or you can say dual or twofold effect on various accounts, and it should therefore be recorded in it is having two aspects, right? So it should be therefore recorded in two different places. The duality principle is commonly expressed in terms of fundamental accounting equations, which is assets is equal to liabilities plus capital. This you all may know. As an accounting student, you should know this. Assets is equal to liabilities plus your capital. So in other words, if you want me to explain, at least two accounts will be involved, or minimum two accounts will be involved in recording any transaction. I will explain you with the help of an example. For an example, let's say like someone ABC started business by investing a sum of 50 lakhs. You can say by investing a sum of 50 lakhs. So the amount of money brought in by ABC company will result in an increase in its assets. That is, the increase in its assets means cash of a business. He brought in the cash 50 lakhs. So cash in its business account will increase. Okay, so cash is coming in of business account. At the same time, the owner's equity or the capital will also increase by the same amount, by an equal amount. Okay. So it may be seen that the two items that got affected by this transaction, that is the 50 lakhs transaction, are cash and which account? Cash and capital account. I will take some other example too to make you understand this further. You see, for an example, suppose a firm is there. A company is there who has purchased some goods worth rupees 10 lakhs on cash. Okay. A firm is there who has purchased some goods worth, listen carefully, a company or a firm is there who has purchased some goods worth rupees 10 lakhs on cash. So what will it do? 10 lakhs cash, he had purchased some goods. So this will increase an asset, that is the stock of the goods on one hand. At the same time, it will reduce another asset, that is the cash on the other hand, because cash is going and the asset is coming inside, that is the goods is coming inside. So the stock of goods one hand will increase because the asset asset has came. On the other hand, it will reduce another asset. Which asset? Cash on the other side. Similarly, if a firm is taking or buying a machine also worth rupees 30 lakhs or anything on credit basis too from some other industries, this will increase an asset. Which asset? What he brought? He brought a machinery. So what he brought? He bought a machinery, right? So this machine is an asset for him. It will increase on one hand. At the same time, liability or a creditor on other side, because this is on cash basis or a credit basis. So liability or a creditor on the other side. So this type is called the dual effect takes place here. So this type is called the dual aspect concept. This type of dual effect takes place in case of all the business transactions. That's why it's called the duality principle. And thus the duality principle is expressed in terms of fundamental accounting equation, which is assets is equal to liabilities plus the capital. Coming back to the next concept, that is realization concept, that is revenue recognition realization concept. It's also called realization concept. What is revenue now? Students, see, what is revenue? Revenue is the gross inflow of cash. What the gross inflow of cash arising from the sale of goods. How will it arise? Gross inflow of cash. Cash, how will it come into our account? When we sell our goods and services by a firm, a company, or anyone who is selling a goods or services. When you sell something, that time only you will get something, right? So revenue is nothing but it's a gross inflow of cash. Inflow means incoming of cash arising from the sale of goods and services by an firm, enterprise, company, or anyone, and used by others of the enterprises resources yielding interest, royalties, and dividends. So make it simple, the concept of revenue recognition or realization concept requires that the revenue for business transactions should be considered realized when a legal right to receive it arises. I will give you an example here. Let's say for rent is there. Okay, in a financial year. So what is the financial year? Financial year will be from April 1 to 31st of March. Let's say rent is there for the month of March. Any year, take this year, March 2022. So March 2022, the rent was for the month of March 2022. Even if the rent amount received in April 2022 will be taken into profit and loss account of financial year ending March 31st 2022 and not into financial year beginning with April, that is the 1st April 2022. Please make it very clear. Revenue recognition, it simply means, for an example, financial year is taken from April 1 to 31st of March. That is, this financial year would be 1st April 2022 to 31st of March 2023. If the rent for the month of March 2022, even if it's received in April, it should take into profit and loss account of which financial year? Of the last previous financial year, that is March 31st 2022, and not in the financial year beginning with April, that is 1st April 2022. Similarly, if the interest for April 2022 interest is received in advance, okay, this is about the rent. Similarly, for the April month, an interest is received which is in advance, we have received in March itself. So what we will do? In which financial year we will add it? It will be taken to the profit and loss account of the financial year ending in March 2023 and not in March 2022. The next concept is the matching concept. Now see here, what is matching concept? Matching is nothing but matching. The concept of matching, it mainly focus on or emphasizes that expenses incurred in an accounting period should be matched with the revenues during that period only. Okay, the expenses, what all expenses have been incurred, that should be matched with the incomes, that is the revenues during that period only. It follows from this time that the revenue and the expenses incurred to earn this revenue must belong to the same accounting year. Understood? I will give you an example. Expenses such as, you can take example of salary. If a company is established and the company need to give salary to its employees, right? The rent to pay, the office rent, the insurance and other details are the expenses for him, which is been recognized on the basis of which period? This accounting period to which they relate, and not when these are paid. Similarly, cost like depreciation of any fixed asset, let's say, is divided over the period during which the asset is been used, because the depreciation means the reduction in the value of any fixed asset is divided, because they are having not only 1 year, they will be having more than 1 year, let's say 3 years, 4 years, 5 years. So how much the asset is been used for so and so years, the entire expenses will be divided into that year. The same type now full disclosure concept. Full disclosure concept, the term itself suggests and says that this concept requires that whatever relevant information, facts, materials which is concerning or focusing the financial performance of an enterprise must be fully transparent, must be fully and completely disclosed in the financial statements and their accompanying footnotes. That means full disclosure, entire disclosure should be done. All the material, relevant facts, information which is pertaining to the financial performance of an enterprise, which says about the enterprise financial status, must be fully and completely disclosed in the financial statements and their accompanying footnotes. Okay. Then the next concept is the consistency concept. Consistency concept. This concept is nothing but it states the consistency means continuous. States the accounting policies, the practices, the principles that all should be followed by each and every enterprises, and what all the practices, principles are being followed, that should be uniform and consistent over a period of time, so that what all results are there that they can compare with each other, right? They can be comparable. So comparability results when it will result when the same accounting principles are consistently being applied by different enterprises for this period under comparison, or the same firm for number of periods. Understood? I will illustrate this to make you understand further. Now see here, an investor is there, right? An investor wants to know the financial status of a company in this year as compared to the previous year. He want to invest in this company. Let's say any company. He want to invest in this company. So what he will say is, what he will see is, we will see his performance. How is the company doing his part this year as compared to the last year. He may compare this year's net profit with that of the last year. So, but if the accounting policies adopted, say with respect to depreciation in 2 years are different, then will it be possible for him to compare? No, because depreciation methods what are they have adopted is different, quite different. So how can he compare? The profit figures will also not be comparable, because the method adopted for the valuation of the stock, that is the depreciation valuation of stock in the past 2 years, is not consistent, that is inconsistent. It is therefore important that the concept of consistency to be followed in order to make clear crystal, that is it can be comparable with the previous year's data with this year's data. Okay, it should be followed in preparation of financial statements so that the results of 2 accounting periods are comparable, so that any investor can compare, and if he want to invest, he can invest. Okay, so the consistency means it eliminates the personal bias. Okay, that's partiality, it eliminates or it completely reduces and helps in achieving results that are comparable. Also, the comparison between the financial results, okay, financial performance of 2 enterprises would be meaningful. When it will be meaningful? When it is the same policies, same methods, accounting methods are implemented and adopted in the preparation of financial statements. Now, there are few more concepts of accounting. These are the 3 concepts you can see in the slide itself. You can see the concepts. So the first concept is the conservatism concept. Conservatism concept. This simply means conservatism, that is the conservatism means this concept or the concept requires that business transactions should be recorded in such a manner that the profits are not overstated. Understood the meaning? Profits should not be overstated. All anticipated, all forecasted or anticipated losses should be accounted for, but all unrealized gains should be ignored. Unrealized, that means the gains are not realized yet. That should be ignored, completely ignored. That's why it's been stated profits are not overstated. Profit should not be overstated. To illustrate you in an example, I will give you, see here, valuing closing stock at cost or market value, whichever is lower, right? So creating provision for doubtful debts, discount on debtors, then comes the intangible, writing of intangible assets like goodwill, patents, etc. from the books of accounts are some of the examples of the how to apply the principle of conservatism. Thus, if a market value of goods see here, thus if a market value of any goods which are bought has fallen down, the stock will show at cost price in the books. Okay, in the books of account it will show the cost price. But if the market value has gone up, the gain is not to be recorded until the stock is sold. If the market value is gone up, the gain should not be recorded until and unless the stock is sold. If the stock is sold, you can show the gain, realize the gain. So this approach of providing for the losses but not recognizing the gains. Losses they are providing and not recognizing or realizing the gains until it's been sold is called a conservatism approach or conservatism concept. The next concept, second last concept, comes the materiality concept. Materiality concept itself means material information, that is the facts and information. This concept states that the accounting should focus on the material information. If the item is likely to influence the decision of a reasonably prudent investor, or you can say the creditors too, it should be regarded as material. It should be regarded as quite important, and it should show in the financial statements. For example, stock of erasers, pencils, stationery, scales, etc. are not shown as assets. Whatever amount of stationery is bought in an accounting period is treated as an expense for that period. Whether consumed or whether used or not, it is treated as an expense. So the amount spent is treated as revenue expenditure, and it should take to the profit and loss account of the same year in which the expenditure is incurred. This is known as the materiality concept. The last concept on accounting is objectivity concept. So what is objectivity? Yes, children, what is objectivity, students? According to this concept, that is the objectivity concept, accounting transactions, whatever transactions are there, the accounting transactions should be recorded in a manner such that it is free from the bias of accountants and others. I hope you are getting my point. Accounting means the accounting transactions. So objectivity, the objective is to the accounting transactions, whatever transactions are there, it should be recorded in a manner such that it should be free from bias or free from any partiality. Nothing partiality should be there. Free from the bias of accountants and other. For an example, let's say a transaction is there for a purchase of materials, may be supported by the cash receipt for the money paid. The cash receipt should be there for the money paid. If the same is purchased on cash or a copy of invoice and delivery challan, okay, if the same is purchased on credit too. Similarly, receipt, if the same is purchased on credit too, okay. Similarly, receipt for the amount paid for purchase of any machine becomes the documentary evidence as a proof its receipt is there, right, for the cost of machine, and it provides an objective basis for verifying these transactions. If in future any issue arises, this is a documentary verification. This is an evidence, documentary evidence will be there for the cost of machine which is been paid, and for that a receipt is been given. An amount paid for the purchase of a machine and a receipt is been given, that is a documentary evidence is being given. So this is an objective basis for verifying any transaction, for verifying any transaction. In this slide we will see the systems of accounting. So what is systems of accounting? As in the slide itself you will know, systems of accounting is divided into two parts: double entry system and single entry system. Double entry system and single entry system. So see here, there are two systems to record the transactions of business. Double entry system, single entry system. So what is double entry? Double entry means double effect. Dual aspect principle will apply here, which states that every transaction has two effects, that is receiving a benefit and giving a benefit. Okay, receiving and giving a benefit. So therefore each transaction involves minimum two or more accounts and is recorded in different places in the ledger. Different places in the ledger. The basic principle is to follow that every debit must have a corresponding credit. Every debit must have a corresponding credit. So a double entry system means it's a complete system as both of the aspects of a transaction are being recorded in the books of accounts. When it comes to single entry system. So now what is single entry system? Single entry system means it is a system which is not fully complete, or which is not a complete system, you can say. It's not a complete system of maintaining records of financial transactions. It does not record the twofold effect or dual aspect. It does not record the twofold effect of each and every transaction. So instead what it will do to maintain all the accounts, what will it do? Only the personal accounts and the cash books are being maintained under this single entry system. So thus the accounts maintained under single entry system are incomplete, not reliable and unsystematic as compared to the double entry system, because double entry system has both debit as well as the credit. If the money is got, then it will be debit, but money has came somewhere, it will be credit. So it would be a clear transaction, or a double transaction would be there, debit as well as the credit. Single entry, there it's incomplete, unsystematic, as only it's recording personal accounts and the cash books. These are the only accounts which are recorded in single entry system. Therefore it's incomplete, unsystematic, and therefore it's not reliable. Therefore it's not reliable. Now here, basis of accounting. So what is basis of accounting? As you can see in the slide, basis of accounting means it's divided into two parts: cash basis and accrual basis. Cash basis and accrual basis. Okay. Cash basis and accrual basis. Now we will see here. See, basis of accounting means that from basis of accounting point of view, the timing of recognition of revenue and cost. There can be two broad approaches. Please listen carefully. From the main point of view of the timing of recognition, when will the revenue or the cost will be recognized, that can be divided into two broad approaches to accounting. So these are the two approaches: the cash basis, accrual basis. Cash basis of accounting itself means under this basis, the entries in the books of accounts are made when the cash is received or paid, and not when the receipt or the payment becomes due. This system is incompatible with the matching principle. Matching concept, you remember the accounting concept? This is incompatible. This is not compatible with the matching concept, which states that the revenue of a period is matched with the cost of the same period, right? I have given you an example too in that. Same is the cash basis of accounting. So now what is accrual basis? Accrual basis means, children, under the accrual basis, revenue and the cost both are recognized in that period itself. Okay, both are recognized in that period itself. Revenue as well as the cost are recognized in the period in which they occur rather than when they are paid. A distinction or a difference is made between the receipt of cash and the right to receive cash. And a distinction is made between the receipt of cash. Receipt of cash means the cash has been received, and right to receive the cash. Similarly, the reverse, and payment of cash and the legal obligation to pay cash. Thus, under accrual basis of accounting, this system, the monetary effect of a transaction is taken into account in this period in which they are earned, rather than the period in which the cash is actually received or paid by the enterprise. I hope you are able to understand and relate to the point and the concepts. I will just revise once again the cash basis and accrual basis. So what is cash basis means? In the books of accounts, when the entries are made in the books of accounts, when the cash is been received and not when the receipt or the payment becomes due. The system is also incompatible with the which concept? Matching concept. So it states that the revenue of a period is matched with the cost of the same period. This is the matching concept. But in the cash basis of accounting, this is incompatible to the matching concept, or you can say matching principle. What is accrual basis? Accrual basis means the revenue and the cost are being recognized in the period in which they occur, rather than when they are paid. So a distinction is made between whatever we receive, that's the cash received, and the right to pay the cash. Cash received and the right to receive the cash, not pay, it will be receive cash, and the payment of cash, totally the reverse, the payment of cash and the legal obligation to pay cash. Thus, under accrual basis of accounting, under this system, the monetary effect of a transaction is taken into account in this period in which they are earned, okay, rather than the period in which the cash is actually received or paid by the enterprise. Okay, I hope you are able to understand, students. So, now children, see here in the slide, accounting standards have been given. This is very important. You need to understand, learn, and you need to remember which standard is for what. Like suppose AS2 is there. You should remember it's for stock. That is the valuation of inventories. AS6, depreciation accounting. AS6 is for depreciation accounting. Like that, there are 32 accounting standards. 32 accounting standards. We will read one by one. So what are accounting standards first? First, I'll confirm what is accounting standards. Accounting standards are written statements of uniform accounting rules and the guidelines, or you can say the principles, practices for preparing the uniform and consistent financial statements, and for other disclosures which are affecting the user of accounting information. I will repeat once again. So what is accounting standards? Okay. What are accounting standards? Accounting standards is nothing but it's a written statement of accounting rules, guidelines, practices for preparing the uniform and consistent financial statements, okay, and for other disclosures which are affecting the user of accounting information. Now see here, however, the accounting standards cannot override the provision of whichever law usages and business environments are there. They can't override, right? So, however, the accounting standards cannot override the provision of applicable law, customs, usages and business environments in the country. So, one guy have defined it, Kohler. He defines accounting standard. This is also very important. Mark it as important. What he is stating as accounting standard is a mode of conduct imposed on accountants by custom, law or professional body. Okay. In order to bring the uniformity and consistency in the reporting of accounting information, the ICAI, that is the Institute of Chartered Accountants of India, they constituted an accounting standard board. They have constituted an accounting standard board in the year April 1977 for developing these all accounting standards. Okay, children. So the accounting standard board submits the draft of the standards to the Council of ICAI, who is Chartered Accountants, Institute of Chartered Accountants of India, which finalizes these accounting standards. So we will read one by one which standard is for which. So see, accounting standards herewith will be called as AS. AS. So the ICAI has issued some following standards. AS1 is for disclosure of accounting policies. Disclosure of accounting policies. AS2 will be for the stocks, that is the valuation of inventories. AS3, accounting standard 3 will be cash flow statements. Accounting standard 4 will be for the contingencies and the events which are occurred after the balance sheet date. Then the accounting standard 5 will be the net profit or loss for the prior period items and changes in the accounting policies. This all you need to remember, learn and understand, children. It will be really helpful for you, not only in the point of exam, but also in the day-to-day point of view. If you go for professional examinations like CA, CS, CFA and all, it will be very helpful for you. Accounting standard 6 will be for depreciation accounting. Accounting standard 7 will be construction contracts. AS8 is for accounting for research and development. AS9 will be for revenue recognition. AS10 will be for accounting for fixed assets. AS10 will be accounting for fixed assets. Now comes the next accounting standard, that is the AS11. It's for the foreign exchange. The effects of changes in the foreign exchange rates. AS12 will be accounting for government grants. AS13 will be for accounting for investments. AS14 will be for accounting for amalgamations. AS15 will be accounting for retirement benefits in the financial statements of employers, recently revised and titled as employee benefits. AS16 will be borrowing cost. AS17 segment reporting. AS18 is for related party disclosures. AS19 leases. AS20 earning per share, that is the EPS, earning per share. AS21 will be consolidated financial statements, is called as CFS. Consolidated financial statements. AS22 will be accounting for taxes on income. AS23 will be accounting for investments in associates in consolidated financial statements. Accounting for investments in associates in CFS, that is the consolidated financial statements. AS24 will be discontinuing operations. The next accounting standard AS comes is AS25, interim financial reporting. AS26 is intangible assets. AS27 will be the financial reporting of interest in joint ventures. It's represented of joint ventures. AS28 is impairment of assets. AS29 provisions, contingent liabilities and contingent assets. AS30 is intangible assets. AS31 will be the financial instrument. Both are financial instrument, children. See here, AS31 and AS32. AS31 is the financial instrument presentation. AS32 is the disclosure of the financial instrument. These are all the accounting standards which you need to remember, not only in exam point of view, but also it will help you a lot if you are applying for professional exam. It will help you a lot. Accounting standards, IFRS, this all you should remember, learn and understand. You should relate each and everything. In this slide, you will see now the IFRS. IFRS is nothing but International Financial Reporting Standards. Now, what is that? International reporting, that is the International Financial Reporting Standards. Herewith, I will call as IFRS. What is that? It is also a set of accounting standards which are developed by the IASB. That is International Accounting Standards Board, the International Accounting Standard Setting Body, which came into existence in the year 2001. Okay, so now see here, the use of a single set of high quality accounting standards would facilitate investment and the other economic decisions across borders, increase market efficiency, and it will reduce the cost of capital. So thus IASB is nothing but International Accounting Standards Board. So it places emphasis on developing the standards based on the sound and clearly stated principles from which interpretation is necessary. Therefore, these IFRS are referred to as principles based accounting standards. Principles based accounting standards. Principle. Therefore, IFRS are referred to as the principle. These are the principles which are based accounting standards. So we can see one by one here. IFRS 1. IFRS 1 means, IFRS means, I am repeating one time. IFRS stands for International Financial Reporting Standard. So what is this? See, IFRS 1 is referred to first time adoption of International Financial Reporting Standards. First time adoption of International Financial Reporting Standards. The second IFRS, that is the IFRS 2 stands for Share Based Payment. IFRS 3 is Business Combinations. IFRS 4 is for Insurance Contracts. IFRS 5 is for Non-Current Assets Held for Sale and Discontinued Operations. IFRS 6 will be Exploration for and Evaluation of Mineral Resources. Okay. IFRS 7 is for the Financial Instruments Disclosures. IFRS 8 is for Operating Segment Operation. There for accounting standard it was accounting standard 17. You need to remember and recollect children. It will help you a lot. IFRS 7. Financial Instrument Disclosure. This is for accounting standard 32. It was there, right? Yes. IFRS 9. Financial Instrument. This is for AS 31. Next comes the IFRS 10. IFRS for Small and Medium Enterprise. SME. Small and Medium Enterprises which provide standards applicable to private entities. That is those that are not publicly accounted as defined in this standard. So now see here. IASB, what is that? In International Accounting Standards Board, they have adopted all the outstanding IAS and SIC issued by the IASC as its own standards. So they have continued to be in force to the extent they are not amended or withdrawn by the IASB. That means that IAS, International Accounting Standard, IAS and SIC, they both can continue to be in force to the extent, only to the extent which are not amended or withdrawn by IASB, that they can follow it. Out of the 41 IAS, out of the 41, that is 41 International Accounting Standard, 12 International Accounting Standards withdrawn, and in effect 29 International Accounting Standard are still applicable. 29 International Accounting Standard are still applicable. Now we will see the next topic. In the slide itself is there IFRS Compliant Financial Statements. In the slide itself you can see now here IFRS Compliant Financial Statements. So what are that? What IFRS need to comply? See, there are 5. First is the financial status, statement of the financial status of an enterprise. Second comes the comprehensive income statement, Third comes the statement of the changes in equity, The fourth comes the statement of cash flow. And the fifth is the notes and the summary of accounting policies. I will repeat once again. First is the statement of the financial position or the status of an enterprise. Second comes the comprehensive income statement. Third is the statement of changes in the equity. Fourth comes the statement of cash flow. And the fifth is the notes and summary of accounting policies. Next comes the difference between, what is the difference between IFRS and IAS? Right? There is not major difference. The basic and the principal difference between the IFRS and IAS is that IFRS is based on principal and fair value. Okay. Whereas IAS are based on the rules and historic value. Only the basic and the principal difference is IFRS is based on which principle? They are based on the principles, normal principles and fair value. Whereas IAS are based on rules and historic value. Thank you. See you on the next class with the next chapter of accountancy. I hope you are able to understand, read and making it very clear to get the not only to score good marks but also to use the accountancy concepts on a day-to-day basis. Thank you.